Welcome back. In this session, we're going to talk about the dual nature of merchandise transaction, and also talk about the closing, adjusting and closing process for a merchandise business. Each merchandising transaction actually affects both a buyer and a seller. And in these illustrations, we're going to show how the same transaction would be recorded by both the seller and the buyer. So our seller is Scully Company, and they sold merchandise on account to Burton Company for $7,500, and the terms are FOB shipping point, which means who's going to pay the shipping. FOB shipping point means free on board shipping point, so that means your buyer is going to actually pay the shipping, and they're going to give them net 45 days. And it says the cost of merchandise sold is $4,500. So first we're going to look at how Scully would record it in their books. So Scully would actually debit their accounts receivable $7,500 and credit their sales $7,500, and then debit their cost of merchandise sold $4,500 and credit the merchandise inventory $4,500. Now Burton is the buyer, so they would debit the merchandise inventory $7,500 and credit their accounts payable $7,500. Burton Company would also have to pay the transportation charges, and it says there are $150 on the July purchase from Scully. And so Scully wouldn't make any entry because it was free on board to them, so they weren't affected by the freight. Burton would debit their merchandise inventory $150 and credit their cash for $150. And this says Scully Company sold merchandise on account to Burton Company. This time they gave them terms FOB destination, which means Scully's going to pay the shipping, and the terms are net 30, and the cost of the merchandise was $3,500. So Scully Company is going to debit their accounts receivable $5,000, credit their sales $5,000, debit the cost of merchandise sold $3,500, and credit the merchandise inventory $3,500. Burton Company would actually debit their merchandise inventory $5,000 and credit their accounts payable Scully Company for $5,000. And then Scully Company paid the transportation of $250 for delivery of the merchandise sold to Burton Company on July the 5th. So Scully Company would actually debit their delivery expense $250 and credit their cash $250, and Burton Company is not affected by that transaction at all. On July the 13th, Scully issued Burton Company a credit memorandum for merchandise return $1,000, and the cost of the merchandise return was $750. So on Scully's books, they would debit the sales returns and allowances for $1,000, credit the accounts receivable for Burton Company $1,000, debit their merchandise inventory for $700, and credit the cost of merchandise sold for $700. Burton Company would debit their accounts payable for $1,000 and credit their merchandise inventory for $1,000. It says Scully Company received payment from Burton for the purchase on July the 5th, and so Scully Company would debit their cash for $4,000, credit their accounts receivable for $4,000. Burton Company would debit their accounts payable for $4,000 and credit their cash $4,000. And it says Scully Company sold merchandise on account to Burton Company for $12,000, terms FOB shipping point, which means that Burton's actually going to pay the shipping on this one. The terms are $210 net EOM, new term, end of month. So even they did this on July the 18th, so if they don't, they should take the discount because they're only going to get to pay it like 2 days later if they don't take it. Scully prepaid the transportation cost of $500, it was FOB shipping point, which means who's going to pay the freight. FOB shipping point means that Burton would pay the freight, but now Scully's already prepaid it, so Scully's actually going to charge Burton for the freight. It says which were added to the invoice, and the cost of the merchandise sold was $7,200. So let's take a look at this transaction. So Scully's going to debit their accounts receivable $12,000, credit their sales $12,000, debit their accounts receivable $500 for Burton Company for the freight, and then credit their cash $500, and then debit the cost of merchandise sold $7,200, credit the merchandise inventory $7,200, and Burton Company would just simply debit their merchandise inventory $12,500 and credit their accounts payable $12,500. Now look at one more transaction. Scully Company received payment from Burton for the purchase of July the 18th, less than 2%, and the 2% is not on the freight; it's only on the merchandise. So it's 2% of $12,000, which would be $240. So this is the way that would look. We would debit our cash $12,260 because it was $12,500, counting the freight, and then minus $240 discount. So we debit the cash, debit the sales discounts, $240, and then credit the receivable $12,500. Burton in their records would debit their accounts payable $12,500, credit the merchandise inventory for the discount that they took $240, and credit their cash $12,260. We're going to look at another example exercise, and this is on exercise 6-6 on page 273 in your book. It says Sievert Company sold merchandise to Bray Company on account for $11,500. The terms are 2/15, so they get a 2% if they pay within 15 days, or net 30 days. The cost of the merchandise sold is $6,900. Sievert issued a credit memo for $900 for merchandise returned and later received the amount due within the discount period. The cost of the merchandise was $540, and it says the cost of merchandise returned, was $540, and it says journalize Sievert Company's and Bray Company's entries for the payment of the amount due. So first we're going to do Sievert, and so we're going to well, it looks like we actually missed a little something here, but we're going to, this is on Sievert's books. We're going to debit our cash $10,388 and credit the sales discounts $212 and credit the accounts receivable $10,600 from Bray Company. And then Bray Company, they would debit their accounts payable $10,600, credit their merchandise inventory for the discount they took $212, and credit their cash for $10,388. And now we're going to talk about the adjusting and closing process for a merchandising business. It's really no different than for a service business, but it is a little more complicated because of the cost of goods sold and the adjustments to inventory and those type things. So let's take a look and see what we're talking about. It says merchandising businesses may experience some loss of inventory due to shoplifting, employee theft, or errors in recording or counting inventory. If the balance of the merchandise inventory account is larger than the total amount of the merchandise count, the difference is often called inventory shrinkage or inventory shortage. So we have to reduce our inventory to its actual value. It says Net Solutions inventory records indicate that they have $63,950 of inventory on hand, but when they actually go out and do that physical inventory, they actually find out they have $6,240 $62,150. So they had $1,800 worth of shrinkage, and that would be recorded in their books by debiting the cost of merchandise sold for $1,800 and crediting the inventory $1,800. And we're going to stop at this point, and then we will pick back up and talk about our closing entries. Thank you, and have a great day.